Bond ratings and bond market. First, bond ratings. There are three major rating agencies, which are Moody's Investor Services or Moody's, Standard and Poor's Corporation or S&P, and Fitch Investor Services. So, bond rating criteria is comprised of three factors, namely financial ratios, qualitative factors, bond contract terms, miscellaneous factors. First is the financial ratios. All of the ratios are potentially important, but the debt and interest coverage ratios are key in dealing with bonds. Rating agencies analysts go through a financial analysis along the lines and forecast for future ratios. Qualitative factors, bond contract terms. So, every bond is covered by a contract, often called an indenture, between the issuer and the bondholders. The indenture spells out all of the terms related to the bond. Included in the indenture are the maturity, the coupon interest rate, a statement of whether the bond is secured by a mortgage on specific assets, any sinking fund provisions, and a statement of whether the bond is guaranteed by some other party with a high credit ranking. Last is miscellaneous qualitative factors. Included here are issues like the sensitivity of the firm's earnings to the strength of the economy, the way it is affected by inflation, a statement of whether it is having or likely to have labor problems, the extent of its international operations, including the stability of the countries in which it operates in, and the potential environmental problems and potential antitrust problems. So here's an example of Moody's and S&P's bonds ratings. The AAA and AA bonds are extremely safe. Single A and AA bonds are also strong enough to be called investment grade bonds, and they are the lowest rated bonds that many banks and other institutional investors are permitted by law to hold. Double B and lower bonds are speculative or junk bonds, and they have significant probability of going into default. So, the importance of bonds. Bond ratings are important to both firms and investors. First, because a bond's rating is an indicator of its default risk. The rating has a direct, measurable influence of the bond's interest rate and the firm's cost of debt. Second, most bonds are purchased by institutional investors rather than individuals, and many institutions are restricted to investment grade securities. Thus, if a firm's bond fall below triple B, it will have a difficult time selling new bonds because of many potential purchasers will not be allowed to buy them. So every every rating is due to change. Rating agencies review outstanding bonds on a specific periodic basis, occasionally upgrading or downgrading bonds as a result of its issuer's changed circumstances. So, for example, on March 6, 2008, S&P downgraded Airborne Health Incorporated's corporate credit ratings from B- to triple C+. The downgrade was largely due to S&P's concern about the company future sales following negative publicity from its recent settlement of a class action lawsuit. So next is bankruptcy and reorganization. A business becomes insolvent, it doesn't have enough cash to meet its interest and principal payments. A decision must be made whether to dissolve the firm through liquidation or to permit it to reorganize and thus continue to operate. So the firm has two options: to reorganize or to liquidate. Which means reorganize means restructuring the debt, in which case the interest rate may be reduced, the term of maturity lengthened, or some of the debt exchanged for equity. The point of restructuring is to reduce the financial charges to a level that is supportable by the firm's projected cash flows. So second is to liquidate. Liquidation occurs if a company is deemed to be worth more dead than alive. If the bankruptcy court orders a liquidation, assets are auctioned off and cash obtained is distributed as specified in Chapter 7 of the Bankruptcy Acts. Next is bond markets. Corporate bonds are traded primarily in the over-the-counter market. Most bonds are owned by and traded among large financial institutions, and it is relatively easy for over-the-counter bond dealers to rearrange or transfer large blocks of bonds among the relatively few holders of the bonds. So here is an example of corporate bonds. If you examine the table closely, you will also see that the bonds with a yield to maturity above their coupon rate trade at a discount, whereas bonds with a yield below their coupon rate trade at a premium above par. We see that the large majority of high-yield bonds trade at a discount to par, which suggests that because of increased default risk, most of these bonds now trade at a higher yield. Thanks.